The illusion of prediction. At the start of each financial year, there is generally optimism in the air. You will see a lot of growth projections being put out. You will see re-ratings being talked about, and the narrative changes to one of positivity. As we start FY27, there are growth expectations on the GDP side, which are in the region of 7.4 to 7.6%. You have a fiscal deficit number which looks like things are very well under control at 4.4% for FY26 and expected to go to 4.3% in the year forward. Inflation, which was a big worry globally at about 6% a while ago, is now down and expected to be at 3% in spite of some of the war worries that exist. This momentum is obviously good news. If you get good, stable macroeconomic factors, it provides a sense of comfort and stability. At the same time, we need to have a certain understanding that a lot of what your outcomes as far as your portfolios will come from discipline, choices of time frame selection, and asset allocation decisions that you end up making. Let's take a set of 3 financial goals. One could be a child education, which is 5 years away, which ideally should be supported by what are called stable or liquid assets. You could have other goals, like a lifestyle goal, which is 10 years away, which is supported by balanced asset, which is essentially a combination of growth asset and stable assets. And you could have your retirement, which is 20 years away, which ideally should be supported by growth assets. One of the things that commonly happens is that you end up in a situation where you may create an asset goal mismatch, which essentially means that for a retirement goal which is 20 years away, if you end up using stable or liquid assets, you end up in a situation where the compounding engine is weak, which means that you could end up having less than what you could have, keeping that 20-year horizon in mind. In much the same way, if you end up using growth assets for a child education which is 5 years away, you could end up in a situation where your plan is fragile because over 5 years, growth assets could be so volatile that they make you very uncomfortable. Therefore, the success in this model will effectively come from doing a match between your goals and your investment strategy. So the world has certainly changed. There has been this huge movement globally towards bilateral trade agreements and free trade agreements. India has actually signed tariff agreements with the European Union, and over a period of time you should see tariffs go down to 0. A trade agreement with the US is also on the cards, and essentially what it's meant is that all of a sudden how sectors, companies and their earnings react are going to get driven partly by how policy around certain geographies gets negotiated between 2 countries. What it could mean is that depending on the type of sector that you invest in, there could be a huge surge in corporate earnings that could follow. And we need to be mindful that a shift in this policy could work for or against your portfolio. Suddenly, investing and the choices that you make in investing are a bit of a puzzle where you're trying to put the pieces together in a manner where you're trying to predict what is going to come next. And it means that you need to be more nimble, you need to be more aware, and you also need to be very, very mindful that all of a sudden an event which is negative for this trade agreement or bilateral agreement could impact your portfolio meaningfully. Being prepared is probably a very, very critical aspect. When you look at your entire picture, you would find that as a domestic investor, having international assets can sometimes be a choice if you don't have goals that are international. But for all investors who have goals which are international and therefore liabilities which are foreign in nature, having foreign assets is a necessity. If you do not have it, you could end up finding that because of currency movements or because of events that happen overseas, your entire financial plan could end up being at risk. And therefore the stability of your plan itself starts to come under question. So the recent face-off between Iran, the US and Israel has actually been a true test to what financial plans have actually got to deal with. Typically, you will find that whenever events of this kind happen globally, there is a risk-off sentiment that happens, which essentially means you see commodity prices go up, like oil, you see currencies get impacted because of worries around inflation, and you see financial markets react negatively because they're not sure about what the future holds. When you have these kind of events take place, it's common to actually see that as an investor, you actually start to worry about what it means for your financial goals. The way to think about this is that if you're in India, for example, when you have oil price pressure that comes in, you will find that there are concerns around inflation that come along with that, and very often the Indian rupee also starts to weaken because India is a large importer of oil. There is a belief that if the oil prices continue to go up, growth will slow down and inflation will also go up at the same time, which are both bad news. As an investor, if your financial goals and your time horizons were not set right when these geopolitical events happen, you could end up feeling very, very uncomfortable. Because if you had parked your money, which was required for a short-term goal, into a growth asset or a risky asset like equities, you could find the sharp correction in equities is actually working against you. And you could end up in a situation where you don't know what to do because you don't exactly know what will happen with the war, how long it will last, and how long this risk-off sentiment will really be. So if you want to get this right, ensure that your structure of your financial plan, the time horizons of your financial goals, and your investment strategy are aligned appropriately so that the risk is not something that you're exposed to. There is a certain bias that comes in when you start to make decisions emotionally rather than based on data. If you look at data currently, you would end up finding, for example, at the start of March, emerging market index versus the India indices are seeing a 70% premium for the India over MSCI emerging markets. As of the end of Jan, over 56% of the stocks in the 500 index in India are actually trading below their highs. When you see all of this data, it's very natural to start to ask yourself saying that are markets overpriced or overvalued or are they cheap? Actually, that's not the right question to ask yourself. The question to really ask yourself is that because of these changes in equity markets, has there been a drift in my asset allocation? What does this really mean? There are times where you actually end up doing decisions on your portfolio very consciously. Maybe when you started off your portfolio a few years ago, you felt that I need a certain mix of assets. Maybe I needed 50% of my assets in growth assets. Maybe I needed 25% of my assets in liquid assets. And I needed another 25% in stable assets. Over a period of time, because equity markets changed, the drift resulted in the equity or growth assets becoming a dominant part of your portfolio, and the stable and the liquid assets suddenly became a very small part. Now this is what you need to worry about as an investor, because when drifts happen, you probably don't realize it till it's probably too late very often. And you then think back and ask yourself saying that, why didn't I actually book some profits or rebalance my portfolio? This is really the strength of what portfolio strategy is about, which is prevent drift from happening. Let's try to illustrate this for clarity. In your asset allocation pie, you have 3 pools that you decided upon. One was your growth asset pool, one was your defensive asset pool or your stable pool, and one was your liquidity pool. Now maybe when you started off, these are all meant to be equal to each other because that's how you as an investor felt comfortable or your financial goals were aligned. Over a period of time, this same chart started to look extremely different, where you had your growth assets now become a very dominant part of your chart, and the stable and the liquid assets became a very small portion. It's important for you to be conscious about this and try to keep your mix as close to where you started off as possible, unless your financial goals themselves have undergone a change. Gold and silver have become very popular amongst investors. We need to keep in mind that commodities tend to go through long cycles of doing very flat sort of behavior. In terms of US dollar returns, gold delivered 0 returns till about 2.5 years ago for a period as long as 12 years. And silver actually delivered 0 returns for close to 14 years. I think this is very much the nature of some of these types of assets. Gold does tend to be an asset that does extremely well when there is fear around and people aren't sure about what's going to happen next. Silver, by its very nature, has industrial demand on one side and also some correlation with some of the fears that people have. And therefore, you will find that these cycles tend to move up and down, and so do the prices of these assets. It is important to remember when they go up, it's tempting to want to step onto the bandwagon, but you need to keep the cyclicality of these assets in mind. Let's try to illustrate this to you in terms of the roles that each of these assets actually play. So if you look at your asset mixes, you'll typically find that there are assets like equity, for example, which are to bring growth into your portfolio. You will find on the other side that there are assets like debt or bonds in your portfolio which are there to give you stability. And then you have commodities in a portfolio which are really there to play the role of hedging. If you are absolutely clear that these roles are specific to the type of asset class, you will probably not get mixed up. So if you expect equities to behave like gold and silver, very often you'll be disappointed because they will not protect you during times of uncertainty. At the same time, if you expect that over long periods of time, there will be a lot of compounding in gold and silver assets, you may once again be disappointed. So please try your best to understand the role of each of these asset classes in your portfolio, and that's what makes portfolios robust and your financial plan secure. Interest rate cycles tend to dominate headlines for very short periods of time, but they can have some material impacts in terms of how you have to think about your money. RBI, in its most recent policies, has been maintaining a downward cut cycle, and therefore with the repo rate now at 5.25% and a neutral stance, there was an expectation that interest rates will continue to head downwards. You are seeing yields at the long end though actually move upwards. And part of this is also happening because you have a new methodology of inflation calculation because of a base year change, where you're now seeing inflation at 2.75%. As an investor, it's important to keep in mind what your financial goals are, and therefore what's likely to be the impact of inflation on those financial goals. If you're someone whose retirement is 2 or 3 years away, you might find that how this interest rate cycle works and what impact it has on you, because the amount of money you will draw out of your portfolio can change depending on what the interest rate cycle is. And you don't probably mind letting go of some growth opportunities in the process. In contrast, if you're an investor who has retirement 20 years away, you may not worry as much. When you start to build a ladder or a methodology where you actually start to put things together across different time frames, your investment strategy can actually end up being different depending on which time frame you look at. So effectively, in a well-constructed portfolio, your portfolio is layered across time in the way that things work. So when you have a 0 to 3 year investment horizon, for example, consisting of assets that are liquid in nature and not very susceptible to how interest rates move. When you have a 3 to 7 year window, instead, you might find that I need a balanced portfolio which could have some of those liquid assets but also have a proportion of growth assets. When you have a 7 year plus cycle available for your goals, you could end up finding that a domination of growth assets may actually be possible. And therefore, if you have long-term assets which are actually aligned to this time frame, you can deal well with volatility. So our suggestion would be that whenever you make decisions around interest rates and your portfolio, keep your time horizon in mind, because basis your time horizon, you will see that layering and structuring of your portfolio across time frames becomes so much easier. So as the new financial year begins, it's quite normal to assume that growth will come in cycles. That's just the nature of how growth is, and it's very hard to predict that in advance. I think the way you need to think about this is that you will not be able to predict this perfectly, but you can plan to be prepared for it. Uncertainty will continue to be there, but you need to learn to plan keeping that uncertainty in mind. So if you're able to get a framework within which you are clear about the financial goals that you have, the time frame that this money is required for, and therefore your investment strategy now gets aligned to that, you will end up finding that you're well prepared in the financial year for whatever it may throw up. And therefore preparedness is really the key to having a successful financial year ahead. Hope you like this content. You can watch more videos by subscribing to our channel, Plan Ahead Wealth Advisors. Do like and share whatever you see here. I'm sure your friends and family will find it useful as well.
Disclaimers: investment in securities market are subject to market risks. Read all the related documents carefully before investing.